As DeFi moves beyond single use cases, are we heading into the era of on-chain financial super apps? I'm Charlie Sherry. Crypto Corner starts now. In today's episode, we're looking at how decentralized finance is maturing, not just as an alternative to TradFi, but as a serious contender for the future of the financial system. Joining us in the studio today is James Hanley, Head of Strategy and Growth at Drift. James, great to have you here.
Good to be here, Charlie.
So let's talk about DeFi. Let's get right into it. I mean, DeFi has emerged as pretty compelling technology over the past few years. In 2021, kind of burst onto the scene. The traditional and alternative financial world got pretty excited about it. But where are we today in 2025?
We've definitely matured a lot since then. I think a lot of the hype of 2021 was imagining what I guess the future of on-chain finance could look like. But I think the version of on-chain finance, so DeFi today, is a lot more evolved, a lot more complex in some regards, but also a lot more mature. There's big trends towards institutions coming into the space, a lot more rigor around risk management. And I think as a whole, finance is on-chain finance is maturing and growing up, I would say.
Okay.
Yep.
And you mentioned, there's more traditional finance acceptance of DeFi. Like what kind of blends are we seeing between, on-chain, crypto, DeFi, and DeFi moving to get more mature, as you talk about, with traditional financial institutions getting involved in the technology?
Yeah, so I mean, what excites TradFi is similar to what excites retail, which is high returns and the volatility, the upside. And what I'm actually seeing right now is a lot of the institutional capital looking to come on chain is really focused around two things. Number one is delta neutral. So how can we capture, how can we generate yield from the volatility of the market? And that's quite achievable on chain because, like I said, it's matured a lot. So the kind of financial instruments that are on chain are a lot more than what was in 2021, which means there's a lot more opportunities for delta neutral returns that are quite attractive to TradFi. So that's the first. Mm-hmm. The second, what I'm seeing is actually, what would I call it? I would call it like, TradFi credit coming on chain. So that's sometimes called RWAs, so real world assets. But what we're seeing is there are big institutions looking to bring private credit into DeFi, which creates really interesting sorts of new ways to generate yield and new ways to basically bridge the gap between on-chain DeFi, which is a lot of the speculative stuff, and then the traditional capital markets like private credit. Yeah,
so you're basically seeing two sort of acceptances there, where you have, TradFi wants a piece of the pie, wants to get the delta neutral, wants to participate in the sort of crypto native volatility, and then you have those institutions bringing their own business on chain to take advantage of the technology.
Exactly.
Which, people in your position might believe is underutilized.
Yep.
In the
but growing
world.
quickly.
Yeah, but growing quickly.
Yeah.
So I guess on the other side, as someone who's used DeFi quite a bit, it is pretty complex and can be, quite a steep learning curve. So what are the big pain points you see today, and is it getting easier for people to kind of pick up and play with, or is it still, a bit cumbersome?
So pain points, what I'm seeing, which basically a lot of DeFi protocols previously chased one single pillar. So for example, just borrowing and lending, or just trading, or just derivatives, or just XYZ, right? But now I'm seeing a bit of a trend towards DeFi protocols integrating different pieces all into the one. That's actually really hard for people to understand, and it's hard for people to intuit what that actually means. So the pain points that I'm seeing is people having to learn not only about like crypto and all of the complexity there, but they're also having to learn quite complex financial concepts at the same time. So it's almost like two learning curves sort of stacked on top of each other, which means there's a lot of information asymmetry. But what's been interesting to me is I've been quite involved in some of the institutional conversations. Well, it's been a big part of what I've been doing for the last few months. And what I've observed is TradFi people that come from that institutional background, they get it. Because what's actually being built today in crypto is very analogous to some things that exist in TradFi. And so it's actually more the sophisticated kind of portion of the market from TradFi that is picking up on these things a lot quicker than, say, the ordinary retail users of DeFi.
Yeah, so you're getting DeFi venues that sort of give you your all-in-one financial experience where you can do your lending, derivatives, trading, as you say. Are you seeing a trend amongst DeFi protocols to go that route instead of specializing in a lending market like Aave? You see something like Jupiter, which is sort of a bit of everything.
Yep. Yeah. So the trend is absolutely in that direction, and there's a particular reason for that. So basically, all of the DeFi protocols that chased one vertical are now realizing that the real unlock for them comes when they start adding others in parallel. And so that's actually what Drift, the company that I work for, that was their core thesis from the beginning, was you build the derivatives DEX first, then you add the borrow lend on top. And when you have those two things combined, it unlocks this like magic that can't exist in isolation of the two. And so pretty much all DeFi protocols, like our competitors, are all doing the same thing. So we were right in the conclusion that that's where things are going, and now we're seeing it across the board.
Yeah, and for people who haven't dabbled in DeFi, users of the traditional financial system, who might have their mortgage with one institution, they might have their equities and brokerage accounts somewhere else. Like, what are some of the benefits and unlocks and capital efficiency gains that can be experienced by using DeFi rails?
So you can't put your mortgage on chain yet, so I won't answer that specific question. But to give the crypto parallel in simple terms, if I'm somebody who holds some Sol tokens, because I really like Solana, this is sort of a true anecdote, but if I'm somebody who holds a bunch of Sol tokens and I believe in Solana, and I have these Sol tokens, but I don't want to sell them. Well, I can go to DeFi, I can deposit them on a DeFi protocol, like Drift, for example, and I can borrow against that. So I could borrow some stablecoins, like USDC, and then I can go and do something with those stablecoins. But the real cool thing that's happening right now in DeFi, like on Drift, is, well, I can keep that Sol position there, and I can borrow against it some stablecoins to go and spend with, to buy things or travel or whatever I'm doing. But at the same time, I can actually use that Sol token as collateral to then, say, trade a derivative to hedge a position in my portfolio, or say bet that something's going to go up. And now I've actually unlocked this capital efficiency, because this one pile of Sol now is actually being able to be used over here and over here and over here. And so I'm able to sort of do a lot more in this one place than if I had all of these things separate. So the analogy there is, without the bank having the mortgage over here and then my brokerage account over there, well, what DeFi is building is it's like the bank and the brokerage all in one.
Interesting. And no doubt you've been pretty exposed to the Solana ecosystem, and Solana has performed pretty well this cycle. And the previous cycle, Ethereum sort of led the DeFi emergence. And this cycle, we've seen Solana have some of the leading DeFi apps, like Jupiter, Drift, where you're based. Why do you think Solana's had that success, and why is it such a good place to house DeFi protocols?
I think it's because the core Solana, core Ethereum leadership was quite anti-DeFi, well, not quite, but somewhat anti-DeFi, and it sort of pushed a lot of DeFi teams out to the edges, onto different layer twos, and it's sort of, what that does, it fragments liquidity. It means you end up with all these little islands that aren't very well connected. And it's really hard to do a lot of complex financial things when you have all these little islands that are really far apart. But in Solana, the thesis was, we need to create one big space that's really fast and really cheap, and have everything built on top, so all the DeFi Lego blocks can talk to each other, all in this one space. So I think it's a philosophical difference between the Ethereum ecosystem. And I say this as someone who still holds all my ETH from the previous cycle, who's praying for the future of Ethereum. But what I would say is, I think it's a core philosophical difference. And when you have everything all in the one place, similar to capital efficiency, like we were talking about, how you get all of these unlocks, right now, we have many different DeFi teams building on top of Drift. And we actually integrate other DeFi teams' products, because it's all on chain. We can just plug and connect, and it creates these really great sort of positive sum sort of outcomes.
Yeah, exciting. Are there any centralization concerns with that on Solana, with it all happening sort of under the one roof, that you might not have on, say, Ethereum?
Centralization concerns, no, because the Solana network is actually quite decentralized now. Initially, early days bootstrapping it wasn't. There was only a handful of validators and clients, but that's changing. It has changed. So yeah, Solana is very decentralized. I think one of the biggest winners in DeFi has actually been Hyperliquid, but they are sort of very centralized, and they've had some problems recently, which I guess some people could point to those centralized components being a concern. So for me personally, I'm not concerned about centralization on Solana. I think it's well and truly past that point.
Okay. Before we wrap up, what do you see as being the next big trends for DeFi? Is it the user experience? Is it like more integration with TradFi? Maybe regulation? Obviously, we've had some changes in the administration in the US who might be more accepting of these sort of complex global protocols. And what do you think are the trends to watch?
Okay, so stablecoins are literally up and to the right. So stablecoin growth chart is pretty much the only chart left in crypto that's just straight up and never goes down. So I think stablecoins is the clear winner. And if you've traveled around the world and you have money on chain, like you and I, for example, stablecoins are just so obvious when you're actually spending globally and moving money globally. So stablecoins for me is the obvious winner. The second in DeFi that I'm seeing is institutional. There is so much institutional interest. There's so much institutional capital coming on chain, which is like private credit, like we talked about, and other things. This is a trend. I see going in one direction as well, similar to stablecoin growth. And then the third for me would actually be that regulatory tailwind in the US. That change in vibe, the change in sort of going from hostile to quite supportive is a huge tailwind for the space. So I think over the next few years, DeFi is going to explode on chain.
Exciting times. Thank you for joining us, James.
Thank you.
And just a quick reminder, this episode is for informational purposes only and does not constitute financial or tax advice. For personalized advice, always speak to a qualified accountant or a financial advisor. This episode is brought to you by BTC Markets. This is Ticker, and we'll be right back.
You're watching Ticker. We'll have more in just a few minutes.